Assalamu alaikum, dear students. Hope you are well. You know, I am Mohammad Samad Khan, lecturer, Department of Accounting, Dhaka College, Dhaka. I think all of you stay at home and stay safe. Dear students, I think that all of you already had done this method and already discussed this in the previous class, but today I am going to take another class on the traditional approach, which is the part of the theory of capital structure. Okay, you already know that traditional method is compromise between two methods, which is net income method and net operating income method. The value of the firm will be increased and or the weighted average cost of capital decreased by the judicious mix of the debt and equity. So we know that if we mix the debt and equity with a judicious view, then we will get a proper feedback from the equity and the debt. I mean, on the time, the weighted average cost of capital will be decreased and the equity or the value of the firm will be increased. So, dear students, I think you already learned this, and I already write down a question in the whiteboard, so you see this what will be written down here. So dear students, please let's go back to the whiteboard. What is seen here, I think uh, uh, in this whiteboard written here, a firm is expected to earn net operating income of taka 1,80,000 taka on a total investment of taka 12 lakh. The the uh, equity of capitalization is 12% if the firm has no debt. I mean, on the time the K is 12%, but on this time there is no debt. Okay, but it would increase to 12.5% when the firm substitutes or substitutes equity capital by issuing debentures of taka 3 lakh at 8% interest rate. Okay, it would increase to 15%, I mean 12.5% to 15% when firm substitutes equity by 6 lakh at 10% debt of interest rate. Okay, then and it would increase to 18%, I mean KE, when the equity capital substitutes by issuing debt at 9 lakh taka at 12%. So here we already seen that the KE is 12% when the firm has no debt, but KE is 12.5% when they are using the debentures of 3 lakh taka at 8%. Okay, but the KE is increased, it would increase to 15% when they use 6 lakh taka debt at 10% interest rate, and the K is 18% when the firm is used of 9 lakh taka in debt at interest rate of 12%. So the interest is, first of all, when is 12% there is no interest, but When is K is 12.5%, on the time is 8% interest with 3 lakh taka, and then K is 15% when interest rate is 10% to 6 lakh taka, and then last one is when is K is 18%, then that is 9 lakh taka to off interest rate, I mean 12%. So dear students, we already know this, what is traditional approach, traditional method. In this maths, in this problem, we should or will bring out the optimum capital structure for the capital decision making. Okay, dear students, let's we solve this math. Okay, dear students, uh, I want to delete this because of lacking the places to write down here. So, dear students, I delete this. Okay. I mean, one, two, three, four, five. So it is particulars. Here, know that here that is 3 lakh at 8% interest rate. Here that is 6 lakh at 10% interest rate. Here that is 9 lakh at 12% interest rate. So net operating income, net operating income is everywhere is 1,80,000 taka. One lakh 80,000 taka. So the debt is debt. Total cost of debt, I mean R, is, there is no debt. Okay, so here 24,000 debt, here then 60,000 debt, then 1,08,000 taka interest, cost of total cost of debt. Okay, I mean it is R. Okay, okay, so I mean here 180,000 taka, it is called net income, which is X bar minus R. Here net operating income, it is in concise in NOI or X bar. Okay, so X bar minus R equal 180,000 taka, then it is I mean 156 1,56,000 taka, 1,20,000 taka, then here 72,000 taka. Okay, then dear students, so as I mean here cost of equity I mean K is in this method 0.12 and in this method 0.125, I mean 12.5%, here 0.15, here 0.18. So so net income, yes, net income. Then cost of equity is here. So what should I? Market value of the shares. So market value of the shares. I mean market value of shares is market value of shares is so X bar minus R divided K. X bar minus R divided KE. So we should okay. So here 180 NY 1,80,000 divided 0.12, I mean 15 lakh. Then 156,000 taka, 1,56,000 divided 0.125, 12,48,000 taka. Then 1,20,000 taka divided 0.15 equal 8 lakh taka. Then 72,000 taka divided 0.18 equal 4 lakh taka. 4 lakh taka. So it is the market value of the shares to the individuals. I mean no debt, and debt in 3 lakh taka at 8% taka, and debt is 6 lakh taka at 10%, and debt is 9 lakh at 12%. So it is the market value of the shares to the individuals. Okay, so here market value of debt, market value of debt. Okay, market value of debt is R divided KD. I mean R divided KD. R divided KD. Okay, so R divided KD. Okay, market value of debt, I mean D. Okay, so here's the no debt, I mean 0. There is no debt. Here debt is 3 lakh taka. Then here debt is 6 lakh taka, and here debt is 9 lakh taka. So total summation is 15 lakh taka. and here plus 3 lakh taka, 15 lakh 48,000 taka, then 14 lakh taka, and then 13 lakh taka. Okay, it is the market value of, it is the total value of the farm. I mean V equal S plus D. I mean S is here S, here is D. So S plus D. S plus D is 15 lakh taka, and when that is 3 lakh taka, then 15 lakh 48,000 taka, then that is 6 lakh taka, but total value of the farm is 14 lakh taka. When that is used 9 lakh taka at 12%, then on the time the total value of the farm is 13 lakh taka. Okay, dear students, so at present we see that the overall cost of capital, then overall cost of capital equal x bar divided V, I mean value of the firm. X bar divided V, I mean value of the firm. Here x bar divided V, I mean 180,000, then divided 15 lakh taka, I mean 0.12. Okay, then x bar 180 divided 1548,000 taka, I mean 11.63, then 14 12.86, here is 12.86%. Okay, then 13.85%. Okay, so in this maths we see that the overall cost of capital is 12% when there is no debt, but 11.63% there is 3 lakh taka debt is used at 8% interest rate, and then 12.86% overall cost of capital when debt is used 6 lakh at 10% interest rate, and overall cost of capital is 13.85% when debt is used on the farm is 9 lakh taka at 12% interest. So I think that, dear students, you see that in this math which column is fixed or shows us that there is the value of the farm is high and the overall cost of capital is lowest, right? So here in the column number 3 and the last row, column number 3 and the last row, see that there is 11.63% overall cost of capital, which is the lowest rate from the others overall cost of capital. Okay, dear students, you see that already here is 12%, here is 12.86%, here is 13.85%. So 11.60% is the lowest from the others. So, and then the value of the firm is 15,48,000 taka. So it is the highest. It is the highest. So we already learned that when the value of the firm is the highest. So in the column number 3 is the highest value of the firm. So we learned that in this chapter, in this math, we learned that the judicious mixed of the debt and equity, the judicious mixed of the debt and equity is called the traditional method. I mean, we already told that the traditional method is the compromise method of the two methods, I mean net income method and net operating income method. So in this maths we already learned this here 11.60 is the lowest overall cost of capital and 15,48,000 taka is the highest, I mean highest the value of the firm. So dear students, I hope that you already realize this class that if you increase the debt elaborately or increase the debt abruptly or increase the debt is huge, but it is not true for your business or for your firm, but you have to maintain the debt and equity ratio with a judicious view. I think all of you already learned this and realized this, and I hope that all of you solve this math at your home. Stay safe, stay at home. Thank you.